Good day, friends. Welcome to my video series on prompting for long-term investing. So far, we have discussed whatever you see on the screen with tick marks or the completed videos or case studies. Presently, we are discussing financial forensic analysis. On the last two videos, we discussed the overview of financial forensics analysis, scopes, objectives, and so on. And the Piotrowski score in the previous video. I request you to please check the last two videos. And in this video, we are going to discuss about the Lev Thiagarajan model. So these are the different use cases or models which we discuss in our overview video. Each of these models is targeted with a particular objective. Like for fraud detection, you have four tools like Binish model, Montier score, Sloan's accruals, and Jones model. Similarly, Piotrowski score, whatever we saw in our previous video, is to do about fundamental strength. Though this may not be purely financial forensics, this Piotrowski score is used or trained or taught in the business schools as part of forensic analysis. So we continue exploring another model which is Lev Thiagarajan 12 signals. This will complete this use case. Moving to the academic background, so going from this and the next video, I will introduce the model first, followed by the prompting techniques. So in the Lev Thiagarajan model, I came across a book some 8-9 years back, using analytics to detect possible fraud, written by Pamela S. Mantone. In that book, there were a lot of tools, models, ratios that can be used by a forensic investigator to analyze fraud or to unearth frauds. So from this book, whatever that I could or a retail investor could pick up to analyze based on financial statements, I mastered most of them, and one of them was Lev Thiagarajan model. Because you and I cannot go and sit inside a company and do the investigation. We only have the public available information, which is the financial statements. So whatever analysis can be done with that statements, only that we can focus as part of financial forensic analysis. So straight to the model, this was founded by Mr. Baruch Lev and Theodore Thiagarajan. They released a paper in 1993, which was titled Fundamental Information Analysis. So we can safely say probably from 1994, the investing community was introduced to this model. The purpose of the model was to identify financial signals that can predict future stock performance. Means whatever signals or whatever ratios it can calculate from the published financial statements, that is being analyzed to predict how the stock would perform in future. So how does it work? So it picks up around 12 signals from a balance sheet, income statement, and some outside data as well. So we will not be able to do those analysis which pertain to outside data, so that we will ignore it. Rest all other signals will do the analysis. These signals are chosen based on which can be used to predict the future earnings. So why I talk about relevance here is not many would have heard about this model. So I just want to say that in MBA and CFA curriculum, this is discussed as part of fundamental and forensic analysis. So now we move to the prompting part. So here, whatever you see is the prompt. Please analyze the financial statements using Lev Thiagarajan 12 signals. Instructions: compute all the 12 signals and present for do it for present and previous year. This is the format where which column I want signal name, then present year with calculation. The with calculation I emphasize because you need to know how it is calculated. So in case you want to verify or cross check, or if you have a doubt how this number was arrived, this calculation will be helpful. And signal direction, whether it has improved from last time or this time or deteriorated. Simple inferences in English, whatever the thing. Then I'm telling that provide a summary with all the red flags, etc., etc. Now I'm going to put it in Claude and use the Carborundum Universal Financial Statements. So let us see now the analysis. Okay, super. It is coming as a table. Previous year revenue. So these are the signals. I told you 12 signals, right? Inventory by sales, account receivable by sales, gross margin, general and accounting advertising sales, depreciation versus the capex on plant equipments, effective tax rate, asset turnover, capital expenditure sales, employee expense per sales, order backlog per sales, audit qualification, and provision sales. Okay, now for each of this, it has given the present year value, how it has calculated, signal direction, whether it has improved or deteriorated, and what is the simple inferences. For example, inventory to sales, companies managing inventory better, holding less stocks related to sales, which is good for cash flow. So you are getting inferences for each of these 12 signals. Something is deteriorated, that is asset turnover, it has already increased. It has increased or decreased. Previous year was higher. Okay, previous year was higher actually. So companies generating slightly less sales per rupee of assets, minor efficiency decline. So this order backlog by sales, that information is not available, so it is not calculating. Even audit calculation, clean audit reports in both the years indicate reliable financial reporting. Super. So now overall assessment summary, positive signals. 11 was measurable, 1 was not measurable, 11 was measurable. Out of 11, 7 was good, and what was the 7 good? And areas of concern. So 4 are not good. What is the reason why 4 are not good? Higher taxes, reduced asset productivity, those reasons. Key takeaway, summarizing whatever we seen above. So I wish to have a bulleted summary, but still I don't know why it gives a paragraph summary. I indicated as a bulleted summary, but still it's giving a paragraph summary. Now we'll repeat the same for Gensol engineering, Gensol financial statements of Gensol engineering using, okay. These are two extreme cases. Basically, these are the two extreme cases which we are discussing. Okay, first one is improved. Second, accounts receivable by sales has deteriorated. Gross margin deteriorated. Depreciation versus PP is deteriorated. Effective tax deteriorated. Asset turnover has improved. Capital expenditure improved. Employee expense per sales deteriorated. Audit qualification no change. Provision by sales deteriorated. So now it is giving a summary. There is some additional context analysis. Gensol has shown an explosive growth, indicating rapid business expansion through acquisitions and organic growth. Financial metrics, total borrowing has increased, assets have doubled almost, and strong cash position. Overall summary, out of 11, only 4 are good. And areas of concern are 7. Key takeaways, like it will summarize whatever is the analysis from the Lev Thiagarajan model. So friends, we will catch up in the next video with another model. Till then, bye.